This is Chad Stejskal, President of Eagle Wealth Management. I'm here with our educational economic update for April 2017. In this month's video, we're going to discuss some of the major headlines that influenced markets in March, and hopefully provide you with some insight into what these developments could mean for you as an investor. With April in full swing, the first quarter of 2017 is now in the books. We won't have quarterly economic data for a while, but what we do know is that all three major U.S. stock market indexes gained at least 4.5% during the first quarter. The NASDAQ even experienced its best quarter since 2013. But most of these gains occurred in January and February, as the NASDAQ was the only one of the three indexes to increase in March. After numerous record highs in February, March saw the S&P 500 flatten and the Dow give back a little less than 1%. While the markets may have provided fewer record-setting headlines in March, we did pass a great milestone in the economic recovery, the 8th anniversary of the Great Recession's lowest market day. Looking at a few data points can show just how far the economy has rebounded since March of 2009. First, consider unemployment. In March 2009, the unemployment rate was 8.7%, and it reached over 10% by October of that year. The most recent readings for 2017 were 4.7%, less than half of the highest rate reached during the recession. Next, GDP also improved. During that same time, from March 2009, we learned that the economy had contracted by 6.3% in the fourth quarter of 2008, its worst decline in 26 years. Well, last month, we received the final fourth quarter 2016 GDP readings, and it reported an increase of 2.1%, which was up from the previous 1.9%. While the recovery pace has been slower than many people would prefer, the economy has grown almost every quarter since 2009. Another sign of our continued economic recovery is the Federal Reserve's tightening fiscal policy. The Fed raises rates in an attempt to keep the economy at a reasonable pace and control inflation. For a decade, between 2006 and 2016, the Fed did not raise rates a single time and actually took the rate from 5.25% to zero between June of 2006 and December 2008. Then, on March 15, 2017, the Fed announced its third interest rate increase since December of 15. The new benchmark rate is still historically low, but we could experience 2 or more increases this year. In fact, the most recent PCE deflator data, a key inflation measure, went beyond the Fed's desired 2% benchmark for the first time since 2012. As a result, some analysts believe we could see more than two interest rate increases for the rest of this year. But for now, anyone with credit card debt, a home equity line of credit, or other liabilities with adjustable interest rate may see an increase in their payment soon. But remember, rising interest rates indicate the economy is growing stronger. Overall, 2017 has experienced a largely positive start, and we continue to see a variety of encouraging economic data. But if you want more guidance on approaching your financial needs or balancing your assets and liabilities in the current interest rate environment, we're here to talk. Well, that's it for this month's educational economic update. Please remember, nothing we talk about here is a recommendation. If you would like to discuss your personal situation, please feel free to give us a call at 541-330-0220, and we'd be happy to set up a time to talk. Once again, this is Chad Stejskal with Eagle Wealth Management. Take care.